One of the really interesting things happening in the financing markets right now are that 10-year treasuries and longer dated bonds are selling off even after the Fed chair said last month they were likely to be less aggressive as it relates to interest rate hikes in the future. So what's going on here? When the Fed chair said that last month, what he was looking at was inflation data suggesting that core PCE was closer to 2.4% and much closer to their target levels, so they wouldn't have to raise rates much further in order to get back to their target. The problem is, in the last few weeks, you've seen a turnaround of real-time inflation data. If you look at the Cleveland Fed's inflation nowcasting, what you're going to see is that core PCE last month is back above 4.3%. What further complicates the picture is that this March is when you saw a low in average wage gains for the American consumer. Since then, you've steadily seen an increase in annual wage gains, and now you're back up to levels close to 6%. And that's going to put even more pressure on inflation when consumers are making more money and have more money to spend. So the problem is this: if the Fed chair is not going to be as aggressive as it relates to raising rates in the future, that means that you might actually have longer periods of inflation over the next 5 to 10 years. And if you have longer periods of inflation over the next 5 or 10 years, that means long-term interest rates are too low. So people are selling 10-year treasuries, and if you look at the charts right now, a number close to 4.3, 4.35% on 10-year yields is extremely important.